Ethics is the foundation of the CFA curriculum. Candidates are expected to know not only what the standards require, but how they are applied in professional practice. Ethics carries significant weight on the exam and serves as a tiebreaker if scores are close to the minimum passing score. Mastery of ethics is essential. The Code of Ethics establishes broad principles. Members and candidates must act with integrity, competence, diligence, respect, and in an ethical manner. They must place the integrity of the capital markets above their own personal interest. They must use reasonable care and exercise independent personal judgment. They must practice and encourage others to practice in a professional and ethical manner that reflects credit on themselves and the profession. They must promote the integrity and viability of the global capital markets for the ultimate benefit of society. The standards of professional conduct expand these principles into enforceable rules. They are grouped into 7 categories. These categories form the structure of most ethics questions. The first category is professionalism. It requires knowledge of the law, independence and objectivity, and proper communication with clients and the public. Professionals must comply with the strictest applicable law or regulation. They must avoid gifts or compensation that could compromise their independence. They must base their recommendations on a reasonable and adequate basis. They must ensure that communications are accurate and complete. The second category is integrity of capital markets. Members and candidates must not act on material, non-public information. They must not engage in market manipulation. The protection of market integrity requires equal access to information and fair trading practices. The third category is duties to clients. The duty of loyalty, prudence, and care is paramount. Client interests come before firm interests and personal interests. Members and candidates must deal fairly with all clients. They must determine investment suitability by understanding the client's objectives and constraints. They must present performance information that is fair, accurate, and complete. They must preserve client confidentiality unless disclosure is required by law or authorized by the client. The fourth category is duties to employers. Members and candidates must act for the benefit of their employer and not deprive the employer of their skills and abilities. They must obtain written consent before engaging in independent practice that competes with their employer. They must not accept gifts or compensation that create conflicts of interest without written consent. Supervisors must make reasonable efforts to detect and prevent violations by those under their supervision. The fifth category is investment analysis, recommendations, and actions. Members and candidates must act for the benefit of their employer and not deprive the employer of their skills and abilities. They must obtain written consent before engaging in independent practice that competes with their employer. They must not accept gifts or compensation that create conflicts of interest without written consent. Supervisors must make reasonable efforts to detect and prevent violations by those under their supervision. The fifth category is responsibilities as a CFA institute. Member or candidate members must not misrepresent or exaggerate the meaning of the designation. They must not guarantee performance. They must not imply partial designation status by passing only some levels. Candidates may state candidacy only if they are registered for the exam. Members must complete the annual professional conduct statement and cooperate with any professional conduct investigations. The exam requires candidates to apply these principles to scenarios. The question style is clinical, with a vignette describing facts followed by a query, such as, which of the following is most accurate, or which action is most consistent with the code and standards? The correct answer is always the one that best protects the client, protects the market, and upholds professional integrity, even if it seems conservative. The overriding principle is that ethics demands placing clients first, protecting markets, acting with independence, and preserving professional integrity. The Code of Ethics sets the ideals. The standards of professional conduct define the rules. The application of both requires judgment, diligence, and care in every professional circumstance.
Ethics questions on the CFA exam are not about memorizing the standards alone. They test judgment in scenarios where multiple answers may appear reasonable. The correct answer is always the one that most closely aligns with the code and standards, protects clients, protects markets, and upholds professional integrity. One recurring theme is material, non-public information. Candidates must not trade or cause others to trade on information that's material and not public. Material information is any information that would affect the value of a security or influence an investor's decision. Public information is information that has been disseminated broadly so that the market has had an opportunity to absorb it. Traps include acting on rumors, partial disclosures, or selective briefings that are not yet public. Another theme is independence and objectivity. Gifts, favors, or compensation that may influence judgment must be refused or disclosed. Modest gifts that do not compromise independence may be accepted, but lavish gifts must not be accepted. Travel paid by clients must be evaluated carefully. Research reports must not be influenced by investment banking relationships. Analysts must base recommendations on reasonable and adequate research, not on pressure from issuers or employers. Suitability is a frequent test point. Recommendations must be consistent with the client's risk profile, return objectives, and constraints. A security may be attractive on its own, but unsuitable for a specific client. Portfolio context matters. For example, recommending a volatile growth stock to a client with a conservative profile is a violation, even if the stock is fundamentally sound. Fair dealing appears in questions about disseminating recommendations. All clients provide favorable treatment to larger or more profitable clients. They must use consistent procedures for disseminating recommendations and executing trades. Performance presentation is another area where traps appear. Returns must be presented fairly, accurately, and completely. Cherry-picking accounts or presenting only profitable results is a violation. Using simulated or back-tested results without disclosure is a violation. The correct answer is always the one that avoids exaggeration or omission. Confidentiality is tested in scenarios involving client information. Members and candidates must preserve confidentiality unless disclosure is required by law or permitted by the client. A common trap is confusing what is legally required with what is permissible. For example, disclosing client information to family members without consent is a violation. Disclosing client information to regulators when required by law is permitted. Duties to employers also produce common traps. Members and candidates must not misuse employer resources or compete without consent. Taking client lists when leaving a firm is a violation. User proprietary models or software outside of the employer is a violation. However, knowledge and skills that are part of personal experience can always be taken to a new role. Conflicts of interest questions focus on disclosure. Any situation where personal interests may conflict with client or employer interest must be disclosed in writing. This includes ownership of securities being recommended, compensation from third parties, and referral arrangements. Traps involve situations where disclosure is partial or verbal. The requirement is always full, fair, written disclosure. Responsibilities as a CFA candidate are tested directly. Misrepresenting candidacy or misuse of the designation is a violation. Candidates may state candidacy only if registered for an exam. Passing 1 or 2 levels does not grant partial designation. Members may not guarantee peer review performance because of the designation. The overriding principle is that ethics are solicited client first judgment. The exam will test scenarios that appear ambiguous. The correct answer is always the one that protects clients, protects markets, and upholds the integrity of the profession.
Financial reporting is the foundation of investment analysis. The objective is to provide information that is useful to investors, creditors, and others in making decisions about providing resources to the entity. This includes assessing the amounts, timing, and uncertainty of future cash flows. The balance sheet presents the financial position at a point in time. Assets represent resources controlled by the firm that are expected to provide future economic benefits. Liabilities represent obligations to deliver resources. Equity represents residual interest after liabilities are deducted from assets. The accounting equation ensures that resources are always balanced by claims. This equation underpins every balance sheet. The income statement presents performance over a period of time. Revenues represent inflows from ordinary activities. Expenses represent outflows or depletion of assets incurred to generate revenue. Net income is the residual after expenses are subtracted from revenues. Earnings per share is required for public companies and is often a focus of analysts. The cash flow statement classifies cash flows into operating, investing, and financing activities. Operate activities reflect the firm's primary business operations. Investing activities reflect the acquisition and disposal of long-term assets. Financing activities reflect the raising and repayment of capital. Analysts use the cash flow statement to assess liquidity, solvency, and financial flexibility. Notes to the financial statements and supplementary disclosures provide critical context. They describe accounting policies, assumptions, and estimates. They provide details about line items, commitments, contingencies, and risks. Analysts must study the notes carefully because many exam questions hinge on details and disclosures rather than headline numbers. International financial reporting standards in the United States generally accepted accounting principles are the dominant frameworks. Both aim to provide useful information, but they differ in treatment of certain items. International standards are principle-based, emphasizing economic substance. United States standards are more rule-based, emphasizing detailed requirements. Candidates must know major differences, particularly in inventory accounting, revenue recognition, and classification of cash flows. Key qualitative characteristics of financial reporting include relevance and faithful representation. Relevance means information can influence decisions by helping users evaluate past, present, or future events. Faithful representation means information reflects the underlying economics without bias, error, or omission. Enhancing characteristics include comparability, verifiability, timeliness, and understandability. Financial reporting quality is a central concern. High-quality reporting reflects the underlying economics clearly. Low-quality reporting may obscure or misrepresent. Quality is not only about compliance, but about transparency. Analysts must identify whether results are sustainable and repeatable or driven by temporary items, aggressive assumptions, or accounting choices. Limitations of financial reporting include judgment in estimates, differences in accounting policies, and the possibility of earnings management. Analysts must adjust reported statements to improve comparability. Examples include adjusting for differences in inventory methods, capitalization versus expensing of costs, or lease classification. The exam will test recognition of which financial statements provide which information, the distinction between principles and rules, the meaning of qualitative characteristics, and the analyst's role in adjusting and interpreting. Questions will often present a scenario and ask which statement is most accurate about what the analyst should conclude. The overriding principle is that financial reporting is about decision-useful information. The accounting equation ensures balance between resources and claims. The income statement explains performance. The cash flow statement explains liquidity and solvency. Notes provide essential context. Frameworks differ but share the goal of faithful, relevant reporting. Analysts must interpret with skepticism, adjust for comparability, and focus on sustainable performance.
Ratios are central to financial analysis because they convert raw numbers into relationships that reveal performance, liquidity, solvency, and efficiency. The CFA exam emphasizes not only calculation but also interpretation. It is not enough to know the formula. Candidates must understand what each ratio means, why it is useful, and what changes in the ratio suggest about the firm's condition. Liquidity ratios measure the firm's ability to meet short-term obligations. The current ratio compares current assets with current liabilities. A higher ratio indicates greater ability to meet obligations, but excessively high values may indicate inefficient use of resources. The quick ratio excludes inventory, focusing on the most liquid assets. The cash ratio focuses only on cash and cash equivalents. These ratios answer the question of whether the firm can meet obligations coming due within 1 year. Solvency ratios measure the firm's long-term financial leverage and ability to meet long-term obligations. The debt-to-equity ratio compares total debt with shareholder equity. A higher ratio indicates greater use of leverage, which may magnify returns, but also magnifies risk. The interest coverage ratio compares earnings available to pay interest with actual interest expense. A higher ratio indicates stronger ability to meet interest payments. The fixed charge coverage ratio adjusts for lease obligations and other fixed commitments. These ratios are critical for creditors assessing default risk. Profitability ratios measure the ability of the firm to generate earnings relative to sales, assets, and equity. Gross profit margin measures profitability after direct costs of production. Net profit margin measures profitability after all expenses. Return on assets evaluates efficiency of asset used to generate earnings. Return on equity evaluates profitability relative to shareholder investment. These ratios are critical for assessing performance and are frequently tested on the exam. Activity ratios measure efficiency of asset utilization. Inventory turnover measures how quickly inventory is sold. Receivables turnover measures how quickly accounts receivable are collected. Payables turnover measures how quickly obligations are paid. Total asset turnover measures overall efficiency of asset use. Analysts must interpret whether high or low turnover is favorable in context of the business model. Cash flow ratios measure liquidity and financial flexibility. Cash flow to debt compares operating cash flow with total debt. Cash return on assets compares operating cash flow with total assets. Free cash flow to the firm and free cash flow to equity measure cash available to providers of capital analysts. Use these ratios to assess the sustainability of dividends, debt repayment, and reinvestment. DuPont analysis decomposes return on equity into components of profitability, efficiency, and leverage. It explains whether changes in return on equity are driven by margins, asset utilization, or leverage. This framework helps analysts understand the drivers of shareholder return. Comparability is critical when applying ratios accounting differences, such as inventory methods, depreciation policies, or lease classification can distort ratios. Analysts must adjust financial statements to improve comparability across firms and over time. Limitations of ratios include reliance on historical data, differences in accounting policies, and potential manipulation. Ratios must be interpreted in context of industry norms, firm strategy, and economic conditions. A single ratio rarely provides sufficient insight. Analysts must use a combination of ratios to form conclusions. The exam frequently tests ratio interpretation. Questions may present financial data and ask which firm is more liquid, which has greater solvency risk, or which is more profitable. The correct answer often requires recognizing what the ratios imply about financial health, not just calculating them. The overriding principle is that ratios are tools for interpretation, not ends in themselves. Liquidity ratios address short-term obligations. Solvency ratios address long-term stability. Profitability ratios address performance. Activity ratios address efficiency. Cash flow ratios address financial flexibility. DuPont analysis addresses drivers of equity returns. Analysts must interpret ratios in context, adjust for comparability, and focus on what they reveal about sustainable performance.
The cash flow statement provides insight that the income statement and balance sheet cannot. It classifies cash movements into operating, investing, and financing activities. Analysts study cash flows to assess liquidity, solvency, and quality of earnings. The exam emphasizes not only classification, but also adjustments needed to improve comparability. Operating activities represent cash flows from the firm's core business. This includes cash received from customers and cash paid to suppliers, employees, and for operating expenses. Under the indirect method, net income is adjusted for non-cash items such as depreciation and for changes in working capital. Under the direct method, operating cash inflows and outflows are reported directly. Both methods result in the same total cash flow from operations. Investing activities include cash flows related to the purchase and sale of long-term assets. This includes capital expenditures for property, plant, and equipment, proceeds from sales of assets, and purchases or sales of investments. Investing activities typically reflect whether the firm is expanding, contracting, or restructuring its asset base. Financing activities include cash flows from raising and repaying capital. This includes issuing or repurchasing shares, issuing or repaying debt, and paying dividends. Financing activities show how the firm funds its operations and returns capital to providers. Free cash flow measures are derived from the cash flow statement and are critical in valuation. Free cash flow to the firm measures cash available to both debt and equity holders after necessary investments. Free cash flow to equity measures cash available only to equity holders after servicing debt. Analysts use these measures to value firms and assets' dividends. Sustainability. Differences between international standards and United States standards appear in classification. Under international standards, interest paid and interest received may be classified as either operating or financing or investing. Dividends received may be operating or investing. Dividends paid may be operating or financing. Under United States standards, interest paid and received are operating. Dividends received are operating. Dividends paid are financing. These differences reduce comparability and require analyst adjustment. Leases create important adjustments under international standards. Most leases are treated as finance leases under United States standards. Operating leases and finance leases are distinguished. Capitalizing operating leases increases reported assets and liabilities, changes the classification of payments, and affects ratios. Analysts must adjust operating leases to improve comparability. Pension accounting also requires scrutiny. Defined contribution plans are straightforward, with contributions expensed as incurred. Defined benefit plans require estimates of future obligations, discount rates, and expected asset returns. Management has discretion in assumptions, which can materially affect reported liabilities and expenses. Analysts often adjust reported numbers to reflect more conservative assumptions. Deferred taxes are another adjustment area. Deferred tax liabilities may arise from temporary differences between accounting and tax reporting. If the liability is not expected to reverse, it effectively represents equity rather than debt. Deferred tax assets represent expected future benefits, but if realization is uncertain, they may be written down. Analysts must assess the economic substance of deferred items. Non-recurring items must be separated from sustainable earnings. Restructuring charges, asset impairments, gains from asset sales, and unusual write-offs must not be treated as recurring. Analysts must adjust reported results to focus on continuing operations. Quality of earnings. Analysis requires identifying whether reported earnings reflects sustainable cash flows or one-time events. Cash flow analysis also supports solvency assessment. Ratios such as cash flow to debt, interest coverage based on cash flow, and reinvestment ratios measure the firm's ability to meet obligations and fund growth. These measures often provide a clearer view of solvency than accrual-based ratios. The exam frequently tests classification differences, adjustments for leases and pensions, interpretation of free cash flow, and the quality of earnings concept. Candidates must identify which adjustments are required for comparability and which items must be excluded from sustainable performance. The overriding principle is that the cash flow statement reveals the firm's ability to generate and use cash. Operating activities reflect core performance. Investing activities reflect asset strategy. Financing activities reflect capital structure. Adjustments for leases, pensions, and taxes are necessary to reveal economic reality. Analysts must focus on sustainable, recurring cash flows as the best indicator of long
Quantitative methods provide the statistical foundation for investment analysis. The exam tests both conceptual understanding and interpretation of results. Questions are designed to see whether you understand what a statistic means and why it is useful, not only whether you can calculate it. Probability measures the likelihood of an event occurring. An event with probability of 0 cannot occur. An event with probability of 1 will occur with certainty. The sum of probabilities across all possible outcomes is 1. Probability may be unconditional, reflecting the likelihood of an event, without regard to other events, or conditional, reflecting the likelihood given that another event has occurred. Understanding conditional probability is essential for interpreting risk scenarios. Random variables represent uncertain outcomes. A probability distribution assigns probabilities to each possible outcome. Discrete random variables take uncountable values, such as the outcome of a die roll. Continuous random variables take on an infinite number of possible values within a range, such as returns on a security. Expected value is the probability weighted average outcome. It represents the long-run average if the random process were repeated many times. Variance measures the dispersion of outcomes around the expected value. Standard deviation is the square root of variance and is the most common measure of risk in finance. Analysts interpret higher standard deviation as greater uncertainty or risk. The normal distribution is the basis for confidence intervals in many hypothesis tests. Sampling introduces additional considerations. A sample statistic is an estimate of population parameter. Many financial models assume normality. Approximately 2/3 of outcomes fall within one standard deviation of the mean, about 95% within 2, and nearly all within 3. The normal distribution is the basis for confidence intervals and many hypothesis tests. Sampling introduces additional considerations. A sample statistic is an estimate of a population parameter. Sampling error is the difference between the statistic and the true parameter. Larger samples reduce sampling error. The central limit theorem states that the distribution of the sample mean approaches normality as the sample size grows, regardless of the population distribution, provided variance is finite. This property allows analysts to apply inferential statistics broadly. Confidence intervals provide ranges within which a parameter is expected to lie with a stated probability. A 95% confidence interval means that if the process were repeated many times, 95% of the intervals would contain the true parameter. Narrower intervals reflect greater precision, which depends on sample size and variability. Hypotheses testing applies statistical inference to decision-making. The null hypothesis represents the baseline assumption. The alternative hypothesis represents the competing claim. Analysts calculate a test statistic, compare it to a critical value, and decide whether to reject the null. A type 1 error occurs when rejecting the null, even though it is true. A type 2 error occurs when failing to reject the null, even though it is false. The significance level reflects the acceptable probability of a type 1 error. The p-value provides another way to interpret results. It represents the smallest level of significance at which the null would be rejected. A small p-value means strong evidence against the null. A large p-value means insufficient evidence to reject. The exam frequently tests the distinction between one-tailed and two-tailed tests. A one-tailed test places the rejection region entirely in one side of the distribution and is appropriate when the alternative hypothesis is directional. A two-tailed test splits rejection regions between both sides and is appropriate when testing for differences without direction. The most common traps include confusing confidence intervals with probabilities of specific outcomes, misinterpreting p-values, and assuming normality when distributions are skewed or have fat tails. The correct answers always reflect careful definition of probability, recognition of sampling error, and conservative interpretation of test results. The overriding principle is that probability and hypothesis testing provide a framework for dealing with uncertainty. Expected value captures long-run averages. Variance and standard deviation measure dispersion. The central limit theorem justifies normal approximations. Confidence intervals provide ranges for parameters. Hypothesis tests guide decisions, but are subject to errors. Analysts must apply these tools with precision and caution.
Correlation and regression extend probability concepts into relationships between variables. The exam tests not only how to interpret coefficients, but also whether you recognize the assumptions, limitations, and potential violations of models. Covariance measures how two variables move together. A positive covariance means that when one variable is above its mean, the other tends to be above its mean. A negative covariance means that when one variable is above its mean, the other tends to be below its mean. Covariance is not scaled and is difficult to interpret directly. Correlation standardizes covariance by dividing by the product of standard deviations. It ranges between -1 and +1. A value of +1 indicates a perfect positive linear relationship. A value of -1 indicates a perfect negative linear relationship. A value of 0 indicates no linear relationship. Correlation is widely used but must not be confused with causation. Spurious correlation can arise when unrelated variables move together by chance or through influence of a third factor. Simple linear regression models the relationship between a dependent variable and a single independent variable. The regression line is chosen to minimize the squared differences between observed and predicted values. The intercept represents the expected value of the dependent variable when the independent variable is 0. The slope represents the change in the dependent variable associated with a 1-unit change in the independent variable. The coefficient of determination, also called R-squared, measures the proportion of variance in the dependent variable explained by the independent variable. A higher R-squared indicates a better fit, but high R-squared does not prove causation or model correctness. measures the dispersion of observations around the regression line. Smaller values indicate tighter fit. Each coefficient can be tested for significance using a t-test. The null hypothesis is that the coefficient equals 0 if the test statistic exceeds the critical value, or the p-value is less than the significance level. The null is rejected, suggesting the independent variable contributes explanatory power. Regression models rely on assumptions. The relationship between dependent and independent variables must be linear. Errors must be independent, have constant variance, and follow a normal distribution. Violations of these assumptions bias estimates and invalidate inference. Heteroscedasticity occurs when error variance is not constant. It leads to underestimated standard errors and overstated significance. Serial correlation occurs when errors are correlated across observations, often in time series data. It also biases significance. Multicollinearity occurs when independent variables are highly correlated with each other, inflating standard errors and making it difficult to assess individual variable significance. Multiple regression extends the model to more than one independent variable. Each coefficient reflects the impact of its variable, holding others constant. Adjusted R squared penalizes the addition of independent variables that do not improve fit. The exam may test whether you recognize when adjusted R squared provides a better measure than simple R squared. Time series analysis applies regression to sequential data. Stationarity is critical. A stationary series has constant mean, constant variance, and constant covariance over time. Non-stationary series produce misleading regressions with high R squared, but no predictive power. A unit root process is the most common form of non-stationarity. Differencing the series can restore stationarity. Autoregressive models explain a variable by its own past values for stability. The autoregressive coefficient must be less than 1 in absolute value. Moving average models explain current values using past error terms. Combined autoregressive moving average models capture both influences. Analysts must test for stability before using models for forecasting.
Equity markets are central to capital allocation. The CFA curriculum emphasizes how prices reflect information, how indexes represent markets, and what this implies for active and passive management. Market efficiency is the degree to which prices reflect available information. The efficient market hypothesis is presented in 3 forms. The weak form states that prices reflect all publicly data, such as prices and volume. If this form holds, technical analysis cannot generate abnormal profits. The semi-strong form states that prices reflect all publicly available information. If this form holds, neither technical analysis nor fundamental analysis can consistently generate abnormal returns, though private information would still have value. The strong form states that prices reflect all information, public and private. If this form held even insider trading would not generate consistent excess returns. Empirical evidence supports weak and semi-strong efficiency in many markets, but generally rejects strong efficiency. Market anomalies are return patterns inconsistent with efficiency. Calendar anomalies include the January effect, where small cap stocks historically showed higher returns in January. Value anomalies show higher returns for value stocks compared with growth stocks. Size anomalies show higher returns for small cap stocks compared with large cap stocks. Momentum anomalies show that securities with strong recent performance may continue to outperform in the short term. Many anomalies weaken or disappear after discovery, suggesting data mining, risk factors, or transaction costs. Implications of efficiency are tested frequently. If weak form efficiency holds, technical analysis offers no value, but fundamental analysis may. If semi-strong efficiency holds, fundamental analysis also offers no consistent advantage, and only private information has value. If strong efficiency holds, no strategy offers consistent abnormal returns. On the exam, the correct answers often favors the more conservative interpretation of efficiency. Indexes provide a way to represent the performance of markets or segments. A price-weighted index gives more weight to higher priced stocks. An equal-weighted index assigns the same weight to each stock, regardless of size. A market capitalization weighted index weights stocks by their market value, which means larger firms dominate. A float-adjusted market capitalization index uses only shares available for public trading. Fundamental weighted indexes use accounting measures such as earnings or book value to set weights. Indexes serve multiple purposes. They measure market performance, serve as benchmarks for portfolios, and underlie passive investment vehicles. An appropriate benchmark must be investable, representative, and transparent. Analysts evaluate performance by comparing portfolio returns with benchmark returns, adjusting for risk. The exam often asks which form efficiency would rule out a particular strategy, or which index type best represents a market segment. Candidates must understand both the theory and the practical implications. The overriding principle is that equity market efficiency determines whether active strategies add value. Indexes provide a practical way to measure performance and guide both active and passive management. Understanding efficiency and benchmarks is critical for interpreting investment results and for answering exam questions with precision.
equity valuation seeks to determine the intrinsic value of a share relative to its market price. The exam emphasizes understanding the models, the assumptions behind them, and their application. Dividend discount models value equity as the present value of expected future dividends. The simplest form assumes dividends grow at a constant rate less than the required return. This approach is best suited for mature firms with stable growth. When growth exceeds the required return, the model does not converge, which is a common exam trap. Two-stage models assume a period of high growth followed by stable growth. The H model smooths the transition between high growth and stable growth by assuming the growth rate declines gradually. These extensions are tested frequently. Free cash flow models shift the focus from dividends to cash available for distribution. Free cash flow to the firm is the cash available to both debt and equity holders after necessary reinvestment. Discounting this measure at the weighted average cost of capital yields firm value. Subtracting debt gives equity value. Free cash flow to equity is the cash available to equity holders after debt service. Discounting this measure at the required return on equity gives equity value directly. Free cash flow models are useful when dividends are not paid, when dividends do not reflect the capacity to distribute cash, or when control of the firm is being valued. Relative valuation uses price multiples compared with fundamentals. The most common is the price-to-earnings ratio, which compares share price with earnings per share. Forward and trailing versions are both tested. The justified price-to-earnings ratio can be derived from fundamentals and depends positively on payout and growth, and negatively on required return. Other multiples include price-to-book, price-to-sales, and price-to-cash flow. Each has advantages and limitations. Price-to-book is less affected by temporary earnings fluctuations, but ignores intangible assets. Price to sales is useful when earnings are negative, but ignores cost structures. Price to cash flow is less distorted by accounting choices, but may misclassify certain cash flows. Enterprise value multiples account for both debt and equity. Enterprise value is market capitalization plus market value of debt minus cash. Dividing enterprise value by earnings before interest, taxes, depreciation, amortization produces a commonly used multiple in mergers and acquisitions. Enterprise value to sales is another common multiple. These are often tested in context of comparing firms with different capital structures. Asset-based valuation values equity as total assets minus liabilities, with adjustments to reflect fair value. This approach is most applicable for firms that are not going concerns, or when asset values are easier to estimate than earnings. The limitation is that it may undervalue intangible assets and does not capture growth potential on the exam valuation question to ask which method is most appropriate for a given context. For stable, mature firms, dividend discount models are appropriate. For firms with no dividends but predictable cash flows, free cash flow models are appropriate. For relative comparisons across peers, multiples are used. For firms in distress or liquidation, asset-based methods are appropriate. The exam also tests interpretation of multiples. For example, if a firm trades at a higher price-to-earnings ratio than its peers, analysts must decide whether this reflects higher expected growth or whether the firm is overvalued. Context, assumptions, and comparability are critical. The overriding principle is that equity valuation is about linking expected benefits to present value. Dividend discount models focus on dividends. Free cash flow models focus on distributable cash. Multiples provide relative comparisons. Asset-based approaches rely on adjusted balance sheets. Analysts must choose the appropriate model for the firm's circumstances and interpret results in light of assumptions and context.
Fixed income securities are central to valuation and portfolio management. The exam emphasizes pricing logic, yield measures, and the structure of interest rates. Candidates must know not only how to calculate, but why measures are used and what they mean. The price of a bond equals the present value of its expected future cash flows, which consist of periodic coupon payments and redemption of principal. If the required yield equals the coupon rate, the bond sells at par. If the required yield is lower than the coupon rate, the bond sells at a premium. If the required yield is higher than the coupon rate, the bond sells at a discount. This relationship is a cornerstone of fixed income valuation. The full price of a bond is the amount paid at settlement and includes accrued interest since the last coupon date. The clean price excludes accrued interest and is the convention for quotations. Analysts must distinguish between full and clean price because exam questions often test this detail. The yield to maturity is the internal rate of return on a bond, assuming it is held to maturity. And all coupon payments are reinvested at the same rate. Yield to maturity links price and cash flows. Other yield measures include the current yield, which compares annual coupon with price, and the yield to call or yield to worst,
which account for embedded call provisions. Effective yield adjust for compounding frequency. Are yield on zero coupon securities for each maturity. A coupon bond can be valued by discounting each cash flow at the spot rate corresponding to its maturity. The process of deriving spot rates from market prices of coupon and zero coupon bonds is called bootstrapping. Spot rates form the building blocks of valuation because they represent the pure time value of money for each horizon. Forward rates are future interest rates implied by current spot rates. For example, a forward rate between year 1 and year 2 is the that links today's 1-year spot rate with today's 2-year spot rate. Forward rates are not forecasts but are implied rates consistent with the absence of arbitrage. They are useful for pricing forward contracts, swaps, and other derivatives. The yield curve depicts the relationship between yield and maturity. A par curve shows yields on bonds priced at par. A spot curve shows yields on zero coupon securities. A forward curve shows implied future rates. The shape of the yield curve provides information about market expectations, liquidity conditions, and risk premiums. Several theories attempt to explain the term structure. The pure expectations theory states that forward rates are unbiased forecasts of future spot rates. The liquidity preference theory states that investors require a premium for holding longer maturities, so forward rates exceed expected future spot rates. The market segmentation theory states that supply and demand within maturity segments determine yields. The preferred habitat theory allows investors to deviate from preferred maturities when compensated sufficiently. Credit spreads measure the difference in yield between credit risky bonds and default-free bonds of the same maturity. Spreads widen in times of stress and narrow when conditions improve. Liquidity also affects spreads. Less liquid bonds require higher yields. The exam may test interpretation of changing spreads as signals of risk perception. Key traps in fixed income questions include confusing clean and full price
misinterpreting forward rates as forecast, or assuming yield curve shape always reflects expectations. The correct interpretation always ties.
Bond prices and yields move inversely. When yields rise, prices fall. When yields fall, prices rise. The relationship is not linear but curved, which means that the percentage price increase from a given decline in yield is larger than the percentage price decrease from an equivalent rise in yield. This property is called convexity. Understanding duration and convexity allows analysts to estimate and manage interest rate risk. Macaulay duration measures the weighted average time to receive a bond's cash flows. It is a time measure but also serves as the foundation for other duration measures. Modified duration measures Macaulay duration to estimate the percentage price change for a given change in yield. A higher duration means greater sensitivity. For example, a duration of 5 suggests that a 1% change in yield will change the bond price by approximately 5% in the opposite direction. Effective duration is used for bonds with embedded options because their cash flows can change when options are exercised. Have lower effective duration when rates fall, because price appreciation is capped by the likelihood of being called due-table bonds. Have lower effective duration when rates rise, because the investors can sell back the bond. Effective duration therefore captures optionality effects that modified duration cannot. Key rate duration measures sensitivity to a change in yield at a specific maturity, holding other maturities constant. This tool captures exposure to non-parallel shifts in the yield curve. For example, a portfolio may be more sensitive to changes in 5 yields than in 10-year yields and key rate duration. Analysis reveals this. Convexity measures the curvature of the price-yield relationship. Duration estimates assume a straight line relationship. Convexity corrects for this by adding a second-order adjustment. Positive convexity means that price gains when yields fall are larger than losses. When yields rise, most option-free bonds have positive convexity. Callable bonds may have negative convexity at low yields because upside is limited by the call feature. Duration and convexity are additive across portfolios. The duration of a portfolio is the market value weighted average of the durations of its holdings. The convexity of a portfolio is the weighted average of convexities. Portfolio managers use these measures to manage overall interest rate risk and to construct hedges. Interest rate risk has two components. Price risk is the risk that rising yields will reduce the value of existing bonds. Reinvestment risk is the risk that falling yields will reduce returns on reinvested coupons. A zero coupon bond has maximum price risk and no reinvestment risk. A coupon bond held to maturity has both risks, which partially offset. Duration matching is a technique that balances these two effects to immunize a portfolio against rate changes. Immunization is used to secure a target return over a specific horizon, regardless of rate movements. A single liability can be immunized by matching asset duration to liability duration. Multiple liabilities require more advanced techniques, such as cash flow matching or key rate duration matching. The exam often tests whether you recognize when duration is the appropriate measure, when effective duration is required, and when convexity must be considered. Common traps include ignoring optionality, confusing key rate duration with effective duration, and misinterpreting convexity signs. The correct answers always emphasize the economic logic. Duration as first order sensitivity, convexity as second order refinement, and effective duration for options. The overriding principle is that duration and convexity modify interest rate sensitivity. Modify duration estimates price.
Corporate finance addresses decisions about how firms invest capital, raise funds, and return value to shareholders. The exam emphasizes capital budgeting, cost of capital, leverage, and payout policy. Candidates must not only know the tools, but also understand why each is used and what it reveals. Capital budgeting is the process of evaluating long-term investments. The objective is to accept projects that increase shareholder value. The most important criterion is net present value. Net present value measures the value added by DIST, counting expected future cash flows at the appropriate cost of capital and subtracting the initial investment. A positive net present value means the project adds value and should be accepted. Net present value is the most reliable method because it directly measures wealth creep. The internal rate of return is the discount rate that sets net present value equal to 0. If the internal rate of return exceeds the required return, the project is accepted. However, internal rate of return can give misleading results when projects differ in size or timing of cash flows, or when cash flows are non-conventional. The exam often presents scenarios where net present value and internal rate of return conflict, and candidates must recognize that net present value is superior. Other capital budgeting tools include the payback period and the profitability index. The payback period measures how long it takes for cash inflows to recover the initial investment. It is simple, but ignores the time value of money and cash flows beyond the cutoff. The profitability index is the ratio of present value of future cash flows to initial investment. A profitability index greater than 1 indicates a positive net present value. It is useful when capital is rationed. The cost of capital is the rate of return required by providers of funds. The weighted average cost of capital reflects the required returns of equity, debt, and preferred stock, weighted by their market values. The after-tax cost of debt is lower than the before-tax cost because interest is tax deductible. The cost of equity may be estimated using the capital asset pricing model, which relates expected return to risk-free rate, market risk premium, and beta. It may also be estimated using dividend discount or bond yield plus risk premium methods. Using the correct cost of capital ensures projects are evaluated against the opportunity cost of funds. Leverage affects both risk and return. Operating leverage arises from fixed operating cost. Firms with high operating leverage experience larger swings in operating income when sales change. Financial leverage arises from fixed financing cost. Firms with high financial leverage experience larger swings in net income when operating income changes. The degree of total leverage combines both effects. High leverage magnifies outcomes and increases risk. Working capital management addresses short-term liquidity. The cash conversion cycle measures the time between paying for inputs and receiving cash from sales. Shorter cycles improve liquidity. Analysts must evaluate trade-offs between liquidity and profitability. Excess liquidity reduces return, while insufficient liquidity increases risk. Dividend policy determines how profits are distributed or retained. Stable dividend policies provide consistency, but may lag earnings changes. Target payout ratio policies adjust dividends gradually toward a target percentage of earnings. Residual dividend policies pay dividends only after funding positive net present value project. Share repurchases are an alternative to dividends and may signal undervaluation, increase financial flexibility, and improve tax efficiency for shareholders. The exam frequently tests the trade-offs in dividend and financing decisions. For example, firms with many positive net present value positive capital provides the correct hurdle rate. Leverage magnifies outcomes and must be managed carefully. Dividend and repurchase policies must balance reinvestment needs with shareholder return. Analysts must focus on whether decisions increase long-term shareholder wealth.
Economics in the CFA curriculum emphasizes how government policy, international trade, and exchange rates affect markets. Candidates are tested not only on definitions, but also on the logical linkages between policy actions and economic outcomes. Monetary policy is conducted by central banks to control money supply and interest rates. Expansionary monetary policy lowers policy rates, increases bank reserves, and stimulates economic activity. Contractionary policy raises rates, restricts reserves, and slows activity. Effective monetary policy requires central bank independence, credibility, and transparency. Independence ensures decisions are free of political influence. Credibility ensures markets believe the bank will maintain stability. Transparency ensures the market understands policy intentions. Fiscal policy is conducted by governments through spending and taxation. Expansionary fiscal policy increases spending or reduces taxes to stimulate demand. Contractionary fiscal policy reduces spending or raises taxes to restrain demand. Fiscal policy effectiveness depends on multipliers. Multipliers are larger when there is excess capacity and when households are more likely to spend additional income. Effectiveness is reduced by crowding out, delays, and political constraints. When monetary and fiscal policy move in the same direction, effects are reinforcing. When they move in opposite directions, effects may offset. For example, expansionary fiscal policy combined with contractionary monetary policy may neutralize each other. The exam often tests recognition of policy mixes and their expected effects on growth, inflation, and interest rates.
International trade is based on comparative advantage. Even if one country is more efficient at producing all goods, trade benefits arise when each country specializes in goods where it has relative efficiency. Absolute advantage is less important than comparative advantage. Trade restrictions such as tariffs, quotas, and subsidies distort efficiency. Tariffs raise import prices. Quotas restrict quantities. Subsidies lower costs for domestic producers. Administrative barriers raise compliance costs. These measures protect specific industries, but reduce overall welfare and may provoke retaliation. Balance of payments records, international transactions. The current account includes trade in goods and services, investment income and transfers. The capital account records capital transfers and acquisition or disposal of non-produce assets. The financial account records investment flows, including direct and portfolio investment. A current account deficit must be offset by a surplus in the capital or financial account. Persistent deficits can pressure the currency. Exchange rates are driven by inflation, interest rates, and trade flows. Purchasing power parity states that currencies adjust so that identical goods cost the same across countries. Relative purchasing power parity states that exchange rate changes equal differences in inflation rates. Interest rate parity links forward exchange rates to differences in interest rates. The forward discount or premium reflects interest differentials. If parity holds, arbitrage opportunities do not exist. The international Fisher relation links nominal interest rates, real rates, and expected inflation, implying that currencies with higher expected inflation will depreciate. The exam often tests interpretation of parity conditions. For example, if domestic inflation is higher than foreign inflation, relative purchasing power parity predicts currency depreciation. If domestic interest rates are higher than foreign rates, interest rate parity implies that the domestic currency trades at a forward discount. Candidates must connect these conditions logically. Economic growth depends on labor supply, capital stock, and productivity. Sustainable growth requires investment in human and physical capital, innovation, and stable institutions. Short-term fluctuations are influenced by policy. Long-term growth depends on productivity improvements. The overriding principle is that economic inks policy, trade and exchange rates with market outcomes. Monetary policy manages liquidity. Fiscal policy manages demand. Comparative advantage explains trade, balance of payments, connects domestic and international flows. Exchange rate parity conditions ensure consistency across inflation. Industry.
Derivatives are instruments whose value is derived from the value of an underlying asset, rate, or index. They are widely used for hedging, speculation, and arbitrage. The exam emphasizes contract features, payoff structures, and relationships that prevent arbitrage. A forward contract is a private agreement between two parties to buy or sell an asset at a specified price on a specified future date. The long position agrees to buy, and the short position agrees to sell. At initiation, the contract has zero value. Over time, value shifts as the spot price and forward price diverge. Forwards are customized, traded over the counter, and subject to counterparty risk. A futures contract is similar in economic exposure, but is standardized and traded on an exchange. Contract terms such as size, maturity, and delivery are set by the exchange. Futures are marked to market daily with gains and losses settled through margin accounts. This process reduces credit risk because the clearinghouse guarantees performance. Futures prices and forward prices converge at maturity, but differences in margining can cause small divergences before that point. Swaps are agreements to exchange cash flows over time. The most common is the plain vanilla interest rate swap, where one party pays a fixed rate and receives a floating rate, and the other does the opposite. Payments are calculated on a notional principle, which is not exchanged. Currency swaps exchange both interest payments and principal in different currencies. Equity swaps exchange returns on an equity index for fixed or floating payments. Swaps allow parties to alter exposures without trading the underlying instruments directly. Options provide the right, but not the obligation to buy or sell an asset at a specified price before or at expiration. A call option gives the right to buy. A put option gives the right to sell. The buyer of the option pays a premium, and the seller receives it. Buyers have limited downside equal to the premium, but unlimited potential upside for calls and substantial downside protection. For put sellers have limited upside equal to the premium, but potentially large downside risk. Options may be European exercisable only at expiration, or American exercisable at any time before expiration. Option payoffs follow clear structures. A long call benefits when the underlying price exceeds the strike price by more than the premium. A long put benefits when the underlying price falls below the strike price by more than the premium. Short positions in calls and puts reverse the payoff profiles. These structures are central to exam questions, which often ask which position benefits under a given market scenario. Relationship between European calls and puts with the same strike and expiration is defined by put-call parity. The price of a call plus the present value of the strike must equal the price of a put plus the price of the underlying asset. If this relationship does not hold, arbitrage is possible. On the exam, recognition of this relationship is critical. Option value depends on several factors called the Greeks. Delta measures sensitivity to changes in the underlying price. Gamma measures the rate of change of delta. Theta measures sensitivity to the passage of time, which is generally negative for long option positions. Vega measures sensitivity to the volatility. Rho measures sensitivity to interest rates. Understanding these sensitivities is important for hedging and risk management. Derivatives markets serve important purposes. They facilitate price discovery, allow transfer of risk, and increase market efficiency. But they also create complexity, leverage, and potential for misuse. The exam tests whether you understand both benefits and risks. The overriding principle is that derivatives are tools for transferring and shaping risk. Forwards and futures lock in prices, swaps exchange cash flows. Options provide asymmetric payoffs, put-call parity ensures consistency. Greeks measure sensitivities, candidates must recognize structures, interpret payoffs, and apply relationships that prevent arbitrage.
You're kind of Investments are assets, other than traditional equities and fixed income. They include real estate, private equity, hedge funds, commodities, and infrastructure. They are characterized by lower liquidity, less regulation, limited transparency, and valuation challenges. They often provide diversification benefits because of low correlation with traditional assets, and they may offer higher expected returns due to complexity, illiquidity, and active management. Real estate can be held directly through ownership of residential or commercial properties, or indirectly through real estate investment trusts and pooled funds. Valuation approaches include the sales comparison method, which uses recent transactions of similar properties, the income approach, which capitalizes net operating income using a capitalization rate, and the cost approach, which estimates replacement cost less depreciation. Real estate values are influenced by rental income, vacancy rates, expenses, and interest rates. On the exam, candidates must identify which method is most appropriate in a given context. Private equity involves investment in companies that are not publicly traded or in public companies taken. Private structures include venture capital and leveraged buyouts. Venture capital provides financing in seed, early or expansion stages. Leveraged buyouts acquire companies using debt financing with the aim of restructuring and improving efficiency. Exit strategies include initial public offerings, trade sales, recapitalizations, and secondary sales. Valuation approaches include discounted cash flow, comparable company multiples, and precedent transactions. Reported returns may be affected by survivorship bias, backfill bias, and appraisal smoothing, which must be recognized on the exam. Hedge funds are private investment vehicles with flexible strategies. They may use leverage, derivatives, and short selling. Common strategies include equity, long, short, event-driven, relative value, and global macro. Hedge fund performance fees typically involve both a management fee based on assets under management and a performance fee based on profits. High watermarks and hurdle rates are often applied. Performance evaluation is difficult because of limited disclosure, lack of standardized benchmarks, and biases in reported data. Candidates must recognize these limitations. Commodities are physical goods such as energy, metals, and agricultural products. Investors gain exposure through futures contracts, commodity funds, and shares of producers. Spot prices are influenced by supply and demand conditions, storage costs, and convenience yield. Convenience yield represents the benefit of holding the physical good, such as ensuring supply. If convenience yield is high, futures prices may be below spot prices, a condition called backwardation. If convenience yield is low, futures prices may be above spot prices, a condition called contango. Commodity indexes are used as benchmarks, but they differ in weighting and composition. Infrastructure investments include assets such as transportation systems, utilities, and communication networks. These assets generate long-lived, stable cash flows, but are illiquid and subject to political and regulatory risks. They are attractive to institutional investors seeking inflation-protected, stable income streams. The exam frequently tests recognition of the features, risks, and valuation methods of alternatives.
Candidates may be asked which approach best values real estate, which buys affects reported hedge fund returns, or how backwardation versus contango affects commodity futures. The overriding principle is that alternative investments expand the opportunity set, but come with unique risks. Real estate depends on income and capitalization rates. Private equity depends on financing structure and exit strategy. Hedge funds depend on manager skill and transparency. Commodities depend on physical supply and convenience yield. Infrastructure depends on regulation and long horizons. Analysts must balance diversification benefits against risks of illiquidity, opacity, and valuation uncertainty.
Portfolio management integrates all areas of finance into the construction of investment portfolios. The objective is to maximize expected return for a given level of risk, or minimize risk for a given level of return. The exam emphasizes diversification, risk, return trade-offs, and performance evaluation. Risk is measured as the variance or standard deviation of portfolio returns. Return is measured as the probability-weighted outcome of future payoffs. When assets are combined, the portfolio's risk is not simply the average of individual risks, but also depends on correlations between assets. If correlations are less than 1, diversification reduces. Portfolio risk. If correlation equals -1, a risk-free portfolio can be created. If correlation equals 1, no risk reduction occurs. Diversification benefits increase as correlations fall, and as the number of assets increases. The efficient frontier represents the set of portfolios that offer the highest expected return for each level of risk. Portfolios below the frontier are inefficient because higher return is available at the same risk. Portfolios above the frontier are unattainable. The efficient frontier is upward sloping and concave, reflecting diminishing marginal returns to risk. The risk-free asset provides a certain return with no variance. Combining the risk-free asset with risky portfolios produces a straight line called the capital allocation line. The optimal risky portfolio is the point on the efficient frontier tangent to this line, and it offers the highest Sharpe ratio. The capital market line is the capital allocation line. When the market portfolio is used as the tangent, all investors who are risk-averse should hold some combination of the risk-free asset and the market portfolio, differing only in proportion depending on risk tolerance. The capital asset pricing model explains expected return as the risk-free rate plus beta multiplied by the market risk premium. Beta measures sensitivity of an asset's return to market return. A beta greater than 1 implies more volatility than the market. A beta less than 1 implies less volatility. The security market line depicts the relationship between beta and expected return. Assets above the line are undervalued because their expected return exceeds required return. Assets below the line are overvalued because their expected return is less than required. Performance evaluation compares realized portfolio results against benchmarks. The Sharpe ratio measures excess return per unit of total risk. The Trainer ratio measures excess return per unit of systematic risk using beta. Jensen's alpha measures the difference between actual return and the return predicted by the capital asset pricing model. A positive alpha indicates value added by active management. The efficient markets hypothesis connects to portfolio management. If markets are efficient, active management cannot consistently add value after costs, and passive management becomes optimal. If markets are not fully efficient, active management may add value, but the burden of proof lies in demonstrating skill net of fees. Portfolio construction must also incorporate investor objectives and constraints. Objectives include required return and risk tolerance. Constraints include liquidity needs, time horizon, tax situation, legal restrictions, and unique circumstances. These are documented in an investment policy statement, which serves as the blueprint for portfolio management. The exam often tests recognition of diversification benefits, the meaning of the efficient frontier, the logic of the capital market line, and the application of performance measures. Candidates must be able to interpret which portfolio is optimal, which asset is undervalued or overvalued, and which performance measure is most appropriate in a given scenario. The overriding principle is that portfolio management is about combining assets to achieve objectives with maximum efficiency. Diversification reduces risk. The efficient frontier identifies optimal combinations. The capital market line extends this by including the risk-free asset. The capital asset pricing model links systematic risk to expected return. Performance measures evaluate outcomes relative to benchmarks. The investment policy statement aligns portfolios with client needs. Analysts must apply these principles